As the 20th century began, petroleum was being found, produced, and wasted. In the U.S., the oil-producing states had to step into the production of petroleum to protect their resources. The relatively short production life and resultant failure of the spindle top field was one of the tragedies caused by a development that was based on haste, perhaps even on greed, through application of the "I want it now" scenario and the resulting "too much too soon" scenario. As the industry progressed in the U.S., changes were necessary. After World War II, the global nature of crude oil changed the supply structure. Historically, crude oil prices have varied from $2.50 to about $3 in 1957 to almost $150 per barrel in the late summer of 2008. In the early part of this time period, the oil-producing countries found increasing demand for their crude oil. But as U.S. demand increased and foreign supplies of petroleum became available, prices were largely defined by what refineries were willing to pay. This system worked fine for refineries, which were usually owned by the larger oil companies, but not for the producers. In 1972, the price of crude oil was about $3 per barrel, and prior to October 1973, the world oil suppliers had very little say in setting the oil prices. Instead, the oil companies, or that is, the oil importers, set the prices. As a result of the Arab-Israeli War of 1973, oil became the weapon of political pressure. The Organization of Petroleum Exporting Countries, OPEC, member nations, became assertive and organized. Oil prices increased to $12 a barrel by 1974. By 1981 to 1983, the U.S. went into a major economic recession. The demand for oil was reduced, and oil-producing nations kept pumping oil in competition to each other to maximize cash inflow. As a result, oil prices decreased, and in 1985, prices were again on the order of $13. The crude oil price spike of the early 1970s was due to an embargo imposed by the OPEC. Less oil without an immediate corresponding decline in oil demand drove prices up. Even if businesses could pay the higher price, they could not get the oil they needed to sustain the pace of economic activity. As a result, real output slowed and costs rose. This put pressure on profit margins, which in turn forced businesses to boost prices. Meanwhile, workers expected prices to continue to rise and demanded even higher wages. Without corresponding productivity gains, this led to stagflation later in the decade. In mid-1985, oil prices were linked to the spot market for crude oil. By early 1986, prices decreased to the lowest levels since the early 1970s and moved downward to $8 to $10 per barrel. The price of crude oil rose again in 1990 with the Iraqi invasion of Kuwait and the ensuing Gulf War, but following the cessation of hostilities, crude oil prices entered a steady decline. However, since then, the demand in the U.S. and Europe has increased approximately 6 to 8% a year, which has at times been a strain on crude oil supply.